Our panel today is Carla Eckert. She is a practice management advisor at the Florida Bar's Practice Resource Center. We have Elizabeth Tarbert, Ethics Counsel at the Florida Bar. Carl Totaro is a CPA and Chief Auditor of the Florida Bar's Lawyer Regulation Department in our Fort Lauderdale office. And we have Tom Boyle, CEO of Trust Books, which is the newest Florida Bar member benefit that's a trust accounting software. He's going to be telling me about that next. And we're just going to go ahead and get started with Carla.
Hello everyone, I am Carla Eckert. We are going to get started with the basics. There is a quick preface, you don't have to read that. The point is, there are different departments within the bar that you will call depending on what your issue is. If you have a question regarding the maintaining of proper records, opening a trust account, closing a trust account, that is the Practice Resource Center, formerly the Practice Resource Institute, formerly LOMIS. Now we are the Practice Resource Center. Our website is legalfuel.com. If you have questions about your own contemplated future conduct with regards to Chapter 5, which are the rules regulating trust accounts, you will call Elizabeth's department, and that's the ethics hotline. If you have to self-report non-compliance, you will need to do that with our Attorney Consumer Assistance Program, ACAP for short. So that's just a little preface. Again, this is not intended as a substitute for your own legal research. We encourage you to read Chapter 5. We're going to be referring back to it a lot. If you haven't read it, it's important. Read it. There are ethics opinions. They're important. Read them. We'll go over them now. Let's get started. All right, Chapter 5. I'm going to test this out, see if this works. No, it's not going to work. It's okay. So there's Chapter 5. If you don't know how to get to that, you can go to floridabar.org. At the top right-hand corner, there's going to be an option for rules and ethics. There's a link. You click rules and ethics, then you click rules, and then you'll scroll down to Chapter 5. Those are the rules regulating trust accounts. Another place you can access those rules is our department website, legalfuel.com. There's also additional resources on legalfuel.com, a short training video, Trust Accounts by the Book, which is presented by Christine Bilbrey, who introduced us today, and Elizabeth Tarbert, who will be speaking in a few minutes. Then there's an extended training video titled Maintaining a Trustworthy Trust Account, also on our website. Both of them cover the basics. The extended one is just really going into much more depth, some of which we will cover here today. Then there are also ethics opinions. You can also access those from the Florida Bar's main site, floridabar.org, top right-hand corner, that same link. Then you're going to click ethics, and you're going to see the subject of ethics opinions on the left-hand side. You're going to click that, scroll down to trust accounts. All the trust accounts related ethics opinions will be in there. So that is just a quick run through of where you can find those resources. Now, why is trust accounting so important? We get this question a lot. Because, some people think, why do I need to do this? Well, one, if you died, if you became incapacitated, would your clients or anyone that's your inventory attorney, anyone that's helping close out your practice or handling your money and dealing with your clients, will they be able to tell how much money you're actually holding for clients? Then what if Carl, our auditor here, came to you and asked you, to produce records? Would you have those records? Would you be compliant? And lastly, it's your responsibility is akin to that of a bank. If you went to your bank and asked, how much money is in my account, it would be unacceptable for them to tell you, well, we don't know. We've been too busy. We haven't been able to get to that. We'll let you know later how much money we're holding for you. That would be unacceptable. You would freak out. Just the same, your clients probably will find it unacceptable if they come to you asking you how much money you're holding on their behalf, and you tell them, I don't know, I don't have that information. So that is why there are rules in place to make sure that you keep a specific set of records to keep you compliant. But it's important to note that trust accounting is not complicated. It's not mysterious. It's, you don't have to be a CPA to understand trust accounting or the record-keeping requirements. Again, it's record-keeping requirements that if you abide by and adhere to, you should have no problem maintaining that fiduciary responsibility to your clients. Key concepts. You'll hear these throughout the presentation. They might be repeated in various ways, but again, just keep them in mind. Client's money must be held separate from the lawyer's money. It is not your money, client money, third-party funds. They're not your funds. So that's why you have a trust account. Keep them separate. Never disburse more money than is in an individual client's trust account. Even if you have a common trust account, each client's funds must be treated like their own separate account, a sub-account, whatever you want to call it. You can never disburse more money than you have than you are holding for that specific client. The next concept, always be able to tell a client his or her balance. I mentioned this earlier. Again, if you keep the appropriate records, if they're up to date, your client should be able to call you at any given moment, and you should be able to tell them down to the penny exactly how much money you're holding. Documentation. The rules do require that you keep a certain set of records. However, you are not limited to just those records. The more documentation, the better, and we'll go over what that is later. Trust accounts must be balanced on a monthly and yearly basis. We'll go through this as well. This is what we call a reconciliation comparison. It's all in the rules. If you've not read them, read them. But if you follow the process that we will talk about today, you will be able to balance your trust account on a monthly basis and ensure that everything is reconciled and every penny adds up. Written accounting must be provided at client's request. Again, client should be able to call you up at any given moment. You should be able to tell them how much money you're holding on their behalf. No negative balances. This is an important one. You cannot overdraft an account if you keep proper records. If you disperse only that amount which you are holding for the client, you should not have any kind of overdraft at all on your account. You can't go negative even on an individual client account. So if your common trust account has $5,000, but for a particular client you're only holding $1,000, you can't disperse more than $1,000. That's it. No negative balances either on a client ledger and definitely not on your journal. Each client must have a final balance of 0. This is the end goal of trust accounting. You always want to make sure that every penny is dispersed. So ultimately you should have no funds that are unaccounted for. You should know where every penny came from and where every penny is going. And again, if you're refunding a client, if you have to return funds to the client, you want to make sure you do that and that you don't let them sit there for all eternity. We get those calls all the time where, members say, well, I've had this money in my account for 7 years and, they don't know what to do with it. So we have to walk them through that process. The goal is for you not to maintain that money for a long period of time in the account. So again, final balance 0, that is your end goal, and that is why you keep these records to ultimately that running balance column on your records ends in 0.
So I'm going to start by confessing my deep, dark secret that I do every time I talk about trust accounting. I have been at the bar 24 years, and I probably advise people on trust accounting at least on a weekly, if not daily basis. I've literally probably advised hundreds, if not thousands of Florida bar members on different ethics issues that relate to trust accounts. And yet, I don't balance my own bank account, ever. I know approximately how much is in it, and I do actually subtract things out of my checkbook, but I don't balance my own bank account. And that's okay, because it's my money. So no one's ever affected but me by the fact that I don't balance my own checkbook. So keep that in mind, though. As Carla said, you are a fiduciary. Your obligation is to treat clients' money better than you would your own. You can ignore your responsibilities about your own money, but you can't do it when it's your own clients. So when are you required to have a trust account? Well, anytime a lawyer accepts money from clients or third parties in connection with representation, the lawyer is required to hold that in trust. And that means the lawyer has to have a trust account. Florida Ethics Opinion 93-2 is a great one to read. It's one that is very seminal on trust accounting. There are many things that a lawyer might accept that do not go into trust. There are things that are required to go into trust, and there are things that are not. So if you accept funds that are yours, that never goes into your trust account. That's commingling if you put it in your trust account with your client's money. So if you accept a retainer, and it's a true retainer, it's earned on receipt, and you're required to put that into your operating account, not your trust account. So anything that is yours goes into your operating account or your personal account if you can't be bothered to have an operating account. And everything that belongs to anybody else, if you've accepted it in connection with any kind of legal representation, that has to be held in trust. Now, if you never take money that belongs to somebody else when you're practicing law, then you're not required to have a trust account. And guess what? Deep secret. You can check yes on the trust accounting certificate. I am in compliance because I'm not required to have a trust account. So because I never accept any funds from third parties or clients in connection with representation. So I'm not required to have a trust account, so I'm in compliance with the rules. So when is a fee considered earned versus unearned? That is, earned is my money, it goes into an operating account, versus it's unearned, it's not my money yet, it might be my money someday, so for now, it goes into trust, and then I can draw against it as I earn it. So again, we'll start with a retainer. A retainer is very frequently misused. A true retainer is money that a lawyer accepts to be available to a client, basically. So it's not for services that you've already provided. It's not for specific services that you're going to provide in the future. It's, I agree to be your lawyer, period. That's considered a true retainer. A lot of people think advances on fees are retainers. They're not. But a true retainer is earned on receipt. The client gave it to you specifically for the purpose of having you available to represent them. That goes into your operating account, not into your trust account. Yes, ma'am.
May we ask questions throughout, or do you want to?
Sure.
defer to the end?
Just wait for the microphone so that it gets picked up.
Just going back to your last topic, quick question. So you've got a firm with 50 or more attorneys. So on the checking of the trust account, does each person check and have to deal with the trust account, or is it the firm as a whole?
Okay, so every single Florida bar member must certify whether or not they're in compliance with the trust accounting rules. So you can be in compliance with the trust accounting rules because you have a trust account and you're following the trust accounting rules. And additionally, you also have to be in compliance with safekeeping property. If you accept property that is not funds on behalf of a client, you have to safekeep that in accordance with the rules as well. So if you accept anything from a client or third party in connection with representation, you have to hold it safely, separately apart from your own property. Now, if you don't accept funds or property from anybody in connection with representation, you still have to certify whether or not you're in compliance with the trust accounting rules. But you can certify you're in compliance because you're not required to have a trust account, or say a safety deposit box or a safe to hold other property. Okay, so a flat fee is a specific set fee that is charged by a lawyer in connection with a particular kind of representation. It happens a lot in criminal cases, immigration cases, tickets. There are a lot of cases where a lawyer will charge a set flat fee. It can be non-refundable. A lawyer's allowed to charge a non-refundable fee. If it is a non-refundable fee, it is yours, it is earned the second the client writes the check to you, hopefully spelling your name correctly. So that's yours, it's earned on receipt, you deposit it into your operating account. If it is not, if you don't designate it non-refundable, it's not yours till the end of the case, until you've concluded the legal services you're providing for the client. So in that case, you actually have to deposit it into trust, and then only move it over to your operating account at the conclusion of the matter when you've actually earned it. So make sure, if you are intending to charge a fee that is a flat fee that is yours and earned on receipt, make sure you designate it non-refundable.
In writing.
And in order to do that, it has to be confirmed in writing. That means you have to have had an agreement with the client that it will be non-refundable. Confirmed in writing doesn't mean you have to have the client sign a contract, although frankly, it's a good idea to have them do it because then it's hard for them to deny you ever had that agreement. But at a minimum, you have to have the discussion with the client, and then you send a letter to the client subsequently, some kind of writing that indicates to them that you have agreed that your fee is non-refundable. Now, I will say, just parenthetically, that's a bit of a misnomer because non-refundable fees are still subject to the excessive fee rule, which means that if at the end of the day, say the client fires you, they drop dead in your lobby after signing their name to the check where they spelled your name correctly, that might be a situation under which you really ought to give the client or their estate some kind of refund. So just because it's termed non-refundable does not mean it's not subject to the excessive fee rule. You still, at the end of the day, have to charge a reasonable fee in connection with your legal services. So an advance on fees, that's what actually most people think of when they think of a retainer. An advance on fees is the client gives you a sum of money against which you're going to bill. Usually it's hourly. So usually you're billing the client, the client might give you $5,000 or $10,000. You put that into your trust account and you withdraw fees within a reasonable time after they're earned. So most lawyers do that on a monthly basis. They just calculate, how many hours they've spent, they send the client an invoice, and then within a reasonable time, they withdraw the fees that they've earned. So what if you get a single payment that is both an advance on fees plus costs, an earned fee plus costs? So I charge you a non-refundable flat fee for a criminal case, but I'm also going to hire an expert on your behalf, and I'm not going to pay for it. I'm not going to advance that, even though I could if I wanted to. I'm not going to advance that fee for you. I'm going to tell you to give it to me, and I'll pay the expert. In that case, because some of the money belongs to a third party, the client, and it hasn't been earned by the lawyer, it's not my money. I have to deposit that entire check into my trust account, and then I withdraw the part that represents my earned fee within a reasonable time, like after it's become collected. Okay, so commingling is prohibited. That's the first thing that Carla started with. I used to actually make these two little pieces of paper, green paper, that looked like money, and one said my money, one said client's money, and I would make people stand on opposite sides of the room as the best visual representation of your client. Your money should never, ever, ever touch the client's money. Your money can never be held with the client's money, nor can your property. So if you accept something to hold for a client, this happens sometimes with estates. You do estate plan, you do probate work, so the client brings in, the PR brings in, jewelry, say, from the estate that they haven't figured out who's going to get what. You have to hold it separate from your own property. So a lot of lawyers have safes for that purpose, or they might have a safety deposit box for that purpose. Again, once you earn a fee, if you're holding an advance on fees in your trust account that you're billing against, you need to withdraw that money within a reasonable time after it's been earned.
All right, and just to emphasize what should never be held in trust, lawyers' personal funds. This seems obvious, but this is not your personal checking account. You cannot, buy your vacations from your trust account, pay for your vacations, or anything that has to do with your own personal expenses. Law firms' operating funds. If you have a separate operating account for your law firm, that's separate from your trust account. You can't pay for office equipment, payroll, rent, utilities, taxes, anything to do with your operating expenses from your trust account. It is not your money. It is not the law firm's money. This next one is, we get this question a lot. Funds unrelated to a representation. So we've gotten calls from people saying, well, my colleague just took on a case. He doesn't have a trust account, but I do. And, I'm not representing the client. I have nothing to do. It's not my case. It's, he just wants to know if I can hold the settlement funds in my trust account because he doesn't have one and he doesn't want to open one. No, you're not representing a client. The funds should not be in your account. You are not a bank for other attorneys. You are not a bank for your clients. So if you have a client who has not hired you to do any particular legal work for them and they just want you to hold money for them because they want to evade taxes, whatever it may be, the answer is no. It must be related to a representation.
Let me just say that protects you. Number one, why do you want to go to the trouble of going through all the trust accounting requirements for someone else? And number two, sometimes somebody wants you to hold funds for a reason that's improper. So, they might be giving you money that they're trying to hide from the IRS, or giving you money because they want your trust to use your trust account to launder their money because it's coming from an illegal transaction. It's really not a good idea to accept funds. So that rule is really partly for your own protection. You're not then going to be responsible for anything other than what you have presumably checked out to be, yes, your client's legitimate money.
All right, now we're going to do the Section 1 review just to make sure everyone's still awake. So Section 1, just to go back, is when is a trust account required? Question 1, in your written fee agreement, you request a non-refundable flat fee of $1,000. The client writes you a check for $1,000. Where do you deposit the check? Yes, non-refundable flat fee goes straight into your operating account because it is earned. Number 2, you have a new client. You advise that you'll require a $3,000 deposit for advance fees. Where do you deposit the check? There you go, unearned. Any advance fees or costs are unearned, and they cannot go into your operating account until you've earned them or until the cost has been incurred. Number 3, in addition to your $1,000 retainer, your written fee agreement requests a cost deposit of $2,000 and an advance fees deposit of $3,000. The client writes you one check for $6,000. Where do you deposit the check? There you go. If any portion of the fee is unearned, the full amount must go into your trust account, and the earned portion must be promptly moved to your operating account. Now, the reverse is not true. You can never put funds, combination funds into your operating account and then move the unearned portion into your trust account. So just remember that. Just because you can put, for a very brief period of time, earned fees when they are part of the same payment into your trust account, the inverse is not true. Number 4, you receive an insurance company settlement check for $20,000 in a personal injury case. Your contingency fee is 33 1/3%, and there's a medical bill for $1,000. The remainder of the settlement funds are due to the client. Where do you deposit the settlement check? There you go. So even though a portion of that has been earned, your fee has been earned, the majority of it is belonging to the client and has to go to pay medical fees, so it goes into the trust account first. Section 2, opening a trust account. So once you've determined whether or not you need a trust account, you'll want to make sure that you set it up correctly, and there's a few things you want to take note of before you do that. Again, reread Chapter 5, but I'm going to hand it back to Elizabeth now.
So there are 2 types of trust accounts, IOTA and non-IOTA. IOTA accounts are interest-bearing trust accounts where the interest accrues to the benefit of the Florida Bar Foundation. The Florida Bar Foundation takes that money and uses it to pay for legal services for indigent people. So the lawyer has to make a determination whether the funds being held for a client or third party are nominal or short-term. If they are nominal or short-term, they have to be placed in an IOTA trust account. Lawyers are the ones who are required to make a good faith determination. I've had many times where a lawyer says, well, can't I just get the client to consent, tell me, sign something saying, hey, it'll go into the Florida Bar Foundation. No, that is a big no-no. The lawyer has to make the good faith determination, because if the client actually makes a decision about the funds, then for IRS, for tax purposes, the client has control over that money, and therefore the client gets the tax burden even though they're not getting the money. So if the client agrees, signs an agreement that the funds go into an IOTA account, that means the IRS can turn around and tax the client on any interest that is earned on that money, even though the money is really going to the Florida Bar Foundation. So it's the lawyer who has to make that determination. Now, it's a good faith determination. I've had many lawyers say, well, how do I know it's short-term or nominal? If you can't really earn beneficial interest on its own, the money, because you're either holding it for such a short period of time or it's such a small amount of money that any administrative costs are going to outweigh any interest you're going to earn, then it's short-term or nominal. So you make that equation on your own. So a non-IOTA account is the other kind of trust account, and there are a lot of lawyers who actually think there's only one kind of trust account. They think there's an IOTA account and that's it. That's all they've ever heard. But if, because you're a fiduciary and you're therefore supposed to treat the client's money better than you would your own, you're supposed to act as a fiduciary to the client and their money. If the money is either such a large amount of money or it's going to be held for such a long period of time, it could generate beneficial interest on its own, then your obligation is to put it into a separate interest-bearing account where the funds, the interest on those funds is accruing to the benefit of the client or third party for whom you're holding the money. So I've also had lawyers ask me this question. Well, what about me? Can't we make an agreement where I get the interest on the money? No, you are a fiduciary. You can never, ever, ever make money off your client's money.
Now, I'm going to interject here. When opening a trust account, you are required to complete 3 forms. The notice to eligible institution is a form that you need to provide to your bank when you're opening the account. The second page has a W-9 that bears the Florida Bar Foundation's taxpayer ID. This ensures that the accrued tax actually goes to the Florida Bar Foundation and that your client is not in any way, shape, or form liable. And this is required for IOTA only. Non-IOTA does not have to fill out the notice to eligible institution because the Florida Bar Foundation is not involved at all in that. The next is the trust account bank notification letter. This one is often overlooked. though it is required by the rules. You can download this from our website along with the other ones, but this form is a template letter that you must complete on your own letterhead. And pursuant to the rules, it authorizes the bank to notify the bar in the event that the account is overdrawn or a trust check is dishonored or returned due to insufficient funds. So again, you are required to submit this to the bank. We've had people tell us, oh, the bank said they don't need this. Not true. They can maintain it on file. You want to make sure that it gets maintained on file because it is required by the rules. The last one is the notice to the Bar Foundation. Once you have opened the account and you have an account number, you want to notify the Bar Foundation that they should be expecting funds coming from your account. So the form will have your law firm name, your name, the account number, so on and so forth. But that is submitted to the Bar Foundation once you've opened the account.
Now, just a little word on that notification letter. Especially in small towns, sometimes you'll know everybody at your bank, and sometimes your bank will feel like they're doing you a favor, and they'll say, hey, Elizabeth, I saw that you got a check returned, but I didn't bother to notify the Florida bar. Don't let them do that. You can get in trouble just for that. The whole point is that the bar is notified so that we know there's a problem with someone's trust account. And again, it's not usually something the lawyer has done. It's usually because your bank officer feels like they're doing you a favor. They are not. So make sure when you give them the letter to tell them to notify the Florida bar when you get a check returned, that they need to actually follow that instruction.
And that notification letter is actually also required for non-IOTA accounts. Chapter 5 still applies to non-IOTA accounts. Just because it is to the benefit of the client doesn't mean that Chapter 5 goes out the window. So we are still required to get notified if you overdraw a non-IOTA account. So be mindful of that.
So what do you call your trust account? Call it trust account. And call it trust account of the name of either your law firm or your name, particularly if you're a sole proprietary. So for me, it would be trust account of Elizabeth Tarbert. It's to show that you're holding money for the benefit of someone else. Do not call it an escrow account. An escrow account is something that usually is connected with real estate. It is something separate. It is something that that person is also a fiduciary who's holding it, but it is not a lawyer trust account. So, and also, do not include the Florida bar's name in it. We are not getting the money. You're not holding it in trust for us. We do not want our name on anybody's trust account or trust account checks. Even though it's an IOTA account, do not put the name of the Florida Bar Foundation on it. You are not holding the money for the Florida Bar Foundation. You're holding the money for clients or third parties. So it needs to be titled Trust Account of Elizabeth Tarbert, PA, for example. Same is true whether if it's a non-IOTA trust account or IOTA trust account, it's still a trust account. Now, for a non-IOTA trust account, if you're holding it specifically for an individual client, you can say for the benefit of FBO and the name of that person, trust account of Elizabeth Tarbert, FBO, John Smith. Also, not only does your trust account need to be labeled clearly and accurately as a trust account, that needs to be true on everything related to that trust account. So it's on your bank statements, on your deposit slips. That's also you create the accurate trail so that if Carlos comes knocking on your door, then Carlos is Leon.
Carl.
Carl, if Carl comes knocking on your door, you will be able to show him all the records that properly can be attributable to your trust account. Okay, so as a relatively recent requirement for trust accounts is to have a written plan. I think that went into effect in 2014. So every law firm that has more than one lawyer has to have a written plan. That is partially so that all the lawyers know that you in fact are following the proper trust accounting procedures, and so they know who to go to in the event they have a question about the trust account. So the trust account plan has to designate the lawyer or lawyers in the firm who are signatories. If you have non-lawyers who are signatories on your trust account, who those signatories are, the lawyer who's responsible for the trust account. A lawyer has to be responsible for the trust account. Specific tasks are delegable, but responsibility is not. A lawyer is always going to be the person who is responsible for maintaining the trust account properly. So the names of the lawyer or lawyers who are responsible for maintaining the trust account and the records properly, that has to be in the plan. And anytime there's a change in any of that information, whether it's a lawyer leaves the firm and another lawyer is taking over being responsible for the trust account, or a non-lawyer who's a signatory leaves the firm and you have a new non-lawyer who's a signatory on the trust account, anytime there's any change in the plan, it has to be updated. and it has to be distributed to all the lawyers in the firm. This is what allows them to check off on their trust accounting certificate that they're in compliance, because they know there's a written plan and they've been given reasonable assurances that their law firm is in compliance with the trust accounting rules.
And you can download those on legalfuel.com. We have a minimum requirements trust account plan prepared by Elizabeth's department. Again, it meets the minimum requirements. The extended one goes into a little more detail, but again, either one will make sure that you can check that box because it is required by the rules. So legalfuel.com.
So we've been hammering into your head, your money can never touch the client's money. Oh my God, they have to be separate, separate, separate. No, you can never, ever, ever have any of your money in a trust account. That's not entirely true. You can have a teeny tiny bit of your own money in a trust account. The reason for that is so you can cover bank charges that are not reasonably attributable to an individual client. So for example, when you get trust accounting checks printed, that's a cost you're not going to try to parcel out amongst all your clients. That's just overhead. That's something that you're going to pay for. So you can keep, and the rules specifically allow it, you can keep a small, reasonable amount of your own money to cover those kinds of charges. Now, when you do that, you need to make sure you treat yourself like a client. So you're going to have it set up your separate ledger card, which Carla will go over in more detail later. You're going to set yourself up as a client. You're going to show your deposit of your own small amount of money to cover those charges. Every time the bank deducts money that is a charge you're taking from your own part of the trust account, you're going to subtract from your ledger card, and you're going to show it on your receipts and disbursements journal as well. And you can then put in enough of your money to reach your normal amount of money that you like to keep in there, just to make sure you have enough to cover those unexpected bank charges.
Now, a recommendation our department often offers when people get a little nervous about having their own funds in the trust account, some banks allow you to assess those fees against your operating account. So you can set it up so that any bank fees or charges come out of operating, even though they're related to your trust account. So it's definitely something you want to ask your bank. They might not offer it off the bat, but if you have your operating and your trust account in the same bank, it's usually something that they can set up. So it's worth asking because it'll make your record keeping a lot easier. It's one less ledger to keep track of. And again, you'll never have to worry about fees being assessed against client funds in the event that you forget to replenish that reasonably sufficient amount.
Okay, so disbursement against uncollected funds. The rules prohibit lawyers from dispersing against uncollected funds except in a very limited set of circumstances. So what does uncollected funds or what does collected funds mean? It does not mean funds are available in your bank account. When a bank tells you have funds available, what that means is they're making a risk calculation based on all the money you are holding in that bank. So it could include your personal account, your operating account, and your trust account. So the bank is going to look at the totals of all of the holdings that you have in their institution, and they're going to make a risk calculation, say, okay, the funds are available. Available is not collected. Collected means they have been deposited, finally settled, and credited against your account. So you need to make sure when you talk to your bank and you're trying to find out if funds are collected, make sure they really mean collected and not just available. There are, however, 6 exceptions that you're allowed to disperse against uncollected funds. So a certified check or cashier's check, loan proceeds issued from a federally or state chartered bank, a bank check, official check, treasurer's check, money order, a check from another Florida bar member's trust account, a check issued by the United States, state of Florida, or a reasonable subdivision of one of those entities, or a check issued by an insurance company, title insurance company, or like entity that is authorized to do business in the state of Florida. And it's a risk issue. I mean, obviously, we think that those are circumstances under which it is very likely the funds are going to become collected at some point, so we'll allow you to disperse against them. However, you have to be aware if you do that, you do it at your own risk. There is always a possibility that someone will put a stop order on one of those checks and the funds will never become collected. And if you have dispersed against them and they never became collected, then the lawyer's responsible for replenishing the funds that are in that trust account because the funds were not collected. So it's permissible, but it is not mandatory. A lot of times a client will be banging down your door going, they want their settlement funds, they want their settlement funds. You are not required to disperse against them until they're collected. So even under circumstances where we allow you to do it, you're not required to do it. So be aware if you do it at your own risk. in case of a shortage, hopefully that will never happen to any of you, but it does happen. It could happen because you dispersed against uncollected funds and someone put a stop order on the check. It could happen because your bookkeeper started embezzling money from you. It happens. It could happen because somebody made a really bad arithmetic error in your account. It can happen. So if you have a shortage, you may replenish the money. You may actually, here's the other exception to the rule that your money can never touch the client's money. If you have a shortage, you may replenish up to the amount of the shortage. You can never replenish more than the amount of the shortage. But if you do that, you have to immediately report it to the Florida Bar. And there's a special email address where you report it. And you have to report what happened, the amount that was short, and the amount you replenished, because those two numbers are not necessarily going to be equal. Some lawyers replenish less than they don't have enough money to cover the entire shortage. So you have to do those things if you're going to replenish.
And that email address is acaptrust@floridabar.org. ACAP, remember, is short for the Attorney Consumer Assistance Program, and that is where you self-report any noncompliance, including a shortage.
So additional things that, we're going to hit these topics over and over again. It's a concept of spiraling in education. If you hit it more, if you spiral back and hit it again, hopefully it sticks. So again, the lawyer is always a fiduciary and is always responsible. A lawyer can delegate specific tasks. You can even have a non-lawyer be a signatory on your trust account. You can have a non-lawyer do your reconciliations for you. You can have your non-lawyer sit and do all the subtraction and addition for the cash receipts and disbursements journal. All of those individual tasks can be delegated to someone other than the lawyer. However, what can never be delegated is the lawyer's responsibility. So ultimately, at the end of the day, if something happens with a trust account, it's on the lawyer. The lawyer's the one who's going to get in trouble. The bar doesn't really regulate non-lawyers, so we're not going to go after your paralegal even if they stole the money. We're going to go after the lawyer. And usually it's going to be if the bar is going to prosecute a lawyer, it's because they didn't adequately train or supervise that non-lawyer. You should never have a situation where somebody steals money from you and you haven't caught it within about a month because you're supposed to be doing the monthly reconciliation. That would be the first time you should be catching the fact that someone is taking money from you because there's maybe checks written out to things that you don't sound like they're a client matter. So you have to invest time in adequately training and supervising your non-lawyer employees. So here's just a couple of helpful tips to help you out with that. Never pre-sign checks. It seems like it's obvious, but you would be surprised at the number of times lawyers have done dumb things, like pre-signed checks. If you pre-sign checks, you might as well just hand them to somebody and say, steal from me. Do not make checks payable to cash. Not only are you not creating an audit trail, anybody can cash a check made to cash. If you wrote me a check on your personal account made out to cash and you dropped it and I saw it on the ground, I could immediately take it to your bank and get your money. So never make it payable to cash because anybody can take it, and Carl, when he sees it, is not going to know what client matter it was related to or what it was for, like expert witness fees. Also, if you do delegate any of these tasks, any of them, to any of your non-lawyer employees, invest the money, and it used to be $20, I don't know what it is now, on having an FDLE background check on that person, because you would be shocked at the number of lawyers who have hired someone who not only is a convicted felon, they were convicted of what? Embezzlement. So that would be a handy dandy thing to know before you put somebody in charge of your trust account. And more things you need to know. First of all, your trust account has to be in the same place where you do business. So it has to be in the same state. So you have to have a bank that's in Florida. They're not hard to find. There are lots of banks who have offices in Florida. It has to be federally insured. It can be a bank, it can be a savings and loan, it can be a credit union, but any of them have to be federally insured. The credit union is actually relatively new. We used to prohibit lawyers from putting funds in credit unions. The only reason is they weren't federally insured. But once credit unions got together and got FDIC to insure them, we said, oh, fine, we'll change our rule, and we did. Now you can put it in a credit union, again, as long as it's federally insured. It's not a rule, but pick a good financial institution. Pick one that's stable, one that's not going to just disappear. I mean, look at the banks are rated. Financial institutions are rated, like lots of other things. Look at their rating. Don't put it in the, I don't know, Bank of Jim Bob. It's just not a good idea. And also remember that FDIC only covers a certain amount, so it only covers $250,000 per client. For a while, there was unlimited coverage, FDIC
It
coverage. but
expired
that's-
in 2013. so-
That's gone now. So remember that it's only $250,000 per client, $2 million total for your trust account. So you want to pick a financially stable institution. And also make sure that they're familiar with IOTA. Most of your major banks in Florida are going to be familiar with IOTA. If you're dealing with a small local bank, they may not be. So it's probably easier to deal with. You're not required to deal with someone who's familiar with IOTA, but it's easier for you if you have an IOTA account.
We, just as a sort of little anecdote, we often get members calling us, telling us, well, yeah, my banker knows about trust funds. And then they come back and we're like, oh, okay, so then you've completed all these forms and you submitted everything you needed to do and you titled the account this way. No, I didn't do that. Turns out that the banker actually set out sort of an estate planning trust fund for them rather than an attorney trust account. So be clear that you want them to set up an attorney trust account, not a trust fund where you're only limited to 5 checks per month, where you have to have a formal document memorializing the estate or whatever it is. IOTA attorney trust accounts are not trust funds. So just again, make sure you deal with a bank, not just a salesperson who's trying to sell you some kind of investment product. And sometimes this requires that you go to the main branch and then thereafter you can go to your local branch. But it's important that you set it up correctly from the onset, because going back and correcting all those issues may be more difficult than it seems. Sometimes the banks won't let you correct titling issues, so you have to close the account and open a new one, and that's just a disaster. So just make sure you set it up correctly with a banker that is familiar with IOTA trust accounts from the onset.
Okay, so do not set up ATM or debit card access. This is a recipe for disaster. It's not prohibited by the rules, but it's really stupid because just like having checks made out to cash, you never have the proper audit trail. So you never have anything that connects the withdrawal that you've made with your debit card or your ATM withdrawal to the client matter that it belongs to and what it was used for. So just don't do it. Also, the rules actually do prohibit overdraft protection. So you cannot ever set up your trust account where it will automatically draw from your personal or your operating accounts to cover any shortages. That is a no-no. That prevents the bar from getting that notification that you've put on file with the bank that they're required. Ooh, is my thing not on? There. Is that better? Okay. Overdraft protection is absolutely prohibited because we told you how to have a letter on file instructing your bank to notify the Florida bar in the event of an overdraft. You're just circumventing that by having overdraft protection. So you're not allowed, you're specifically absolutely not allowed to do it. So here's just another little handy dandy tip. I always get most of my handy dandy tips from the auditors. Use separate colors for your bank account, your operating account, and your trust account. It's just a visual cue. Oh, wait a minute, this was supposed to be written on the trust account, or oops, that was supposed to be written on the operating account. Make them, and if you're colorblind, do something else. Make a different design instead of different color. Another thing, and this is the most, I think, important thing a lawyer can do, in my opinion, make sure that you yourself personally review your monthly statement and you receive it unopened. And even better than that, have it sent to a P.O. box where only you have the key. Because the problem is it off again? Oh, this thing keeps, I don't know what to tell you.
Battery's probably off, but it's still picking up volume, but maybe you should hear that little one.
We'll do this. We'll just get closer. Okay, so make sure you review your own monthly statement from your bank, and our suggestion is you receive it at a location where you are the only person who has access, like a P.O. box where only you have the key. If you receive it at your office, there is always the possibility. People often think, oh, well, obviously it's unopened. No, somebody could have steamed it open and sealed it back up with a glue stick. It's really not hard to do. Additionally, somebody could take your statement if you receive it at your office and they can Photoshop it to Photoshop out all of the transactions that they did themselves for their person to embezzle money from you. And I mean, people laugh about it, but it's actually happened. Carl Carl can attest to this. This has actually happened where a lawyer has had a non-lawyer not only embezzle, but Photoshop the monthly statements so that they took out the transactions that they themselves, that showed it was going to, the money was going to them or was going to cash, and made them look like legitimate transactions. So it's not hard to do these things anymore. With computers, it's really not. So you need to make sure that you yourself are receiving your monthly statement and you're actually looking at it, and ask questions. Even if you don't actually have any real questions, if you are trusting someone else with any of the tasks associated with your trust account, ask questions anyway. Make something up to ask somebody about so they know you're paying attention. Yes, ma'am. Yes, please.
Where does the bar stand on the electronic statements, or do you need the physical statements?
Okay.
You know, because I know my bank automatically produces the electronic
You,
ones.
you can most definitely keep, the bar doesn't, in one way or another, you can keep paper records, you can keep electronic records. You have to be mindful, though, that banks don't keep records for the 6 years that we require you keep them.
Right.
So if you do rely on the electronic statements, download them. Same thing with the check images, the front and back of the check images. Download them immediately, because if you 5 years down the line, you're waiting to, provide Carl your records, they might not be there. Most banks, I believe the average is about 3 years that they keep online records. So anything beyond that is lost, essentially, and then you're not in compliance with the 6-year rule, so.
Thank you.
Same thing with your reconciliations. There are people who say, can I do my reconciliation online? Yes, you can, but you need to make sure you either PDF it to show that you've done it or print it out to show that you've done it and keep that record. Because otherwise, you can't establish that you actually did do the reconciliation, even if you did do it.
All right, Section 2 review. Everyone's awake still? All right. Number 1, you're representing a client in a multi-million-dollar real estate development project. The development project is expected to take at least 2 years, probably longer. Your client writes you a check for $20,500,000, $550,000 in advance fees, and $19,950,000 in advance costs. Where do you deposit the check? Or wire, whatever. Non-IOTA. These numbers are exaggerated, but these deals happen. So again, it is likely that your client can earn income on $20 million or $19,950,000. So again, likely it's going to go in a non-IOTA trust account because it is not nominal and not short-term. Number 2, your client asks you to prepare and file Florida Articles of Organization. You advise that you'll require a $500 deposit for advance fees and a $160 cost deposit. The client writes you a check for $660. Where does the deposit go? IOTA. There you go. Florida Bar IOTA is a proper trust account title. True or false? False. The name of the lawyer or law firm and the words trust account. Never IOTA, never the Florida Bar, never the Florida Bar Foundation or escrow or anything that doesn't align with your law firm name or the words trust account. Number 4, it is always permissible to disburse against uncollected funds. True or false? Yes.
Did you just say you never use the word iota?
That's correct. You don't want to use even though it is an IOTA account, the rules say that you must designate the account as a trust account. So putting IOTA on the title doesn't necessarily designate it as a trust account. Yes?
What is an IOTA trust account?
I'm sorry, what?
It's IOTA trust account.
With the name of the firm.
Lawyer, law firm,
Yeah,
name, the words
it's
trust
the
account.
firm, IOTA trust.
You could, but
You're making it longer for your clients.
yes, exactly. It's harder to write out the check.
So the question, I don't know if the video got that, but the question was if you call it the lawyer law firm name, the words trust account, and then also include IOTA in there, technically you've used the lawyer law firm's name and the words trust account. So if you want to go ahead and add IOTA, that's on you. But again, just be mindful that that's one more thing to include on the check when your clients write out the check. So.
As long as the word trust account is it within the title, that's okay. If it also has IOTA, that's all right. But if it's just IOTA, that's no good. It must include the word trust.
So I'll go back to number 4. There were crickets in the room. It is always permissible to disburse against uncollected funds. True or false? Good. It's not always permissible. There are 6 exceptions that Elizabeth went over. We can go over those again if anyone is confused, but it's not always permissible. And in fact, it's at your own risk, even if you do fall within those 6 exceptions. If there is a shortage for whatever reason, you are required to replenish the account. So that is definitely false. Number 5, a Florida registered paralegal, meaning they are registered with the Florida bar, who embezzles funds from the firm's trust account is personally liable, not the supervising lawyer or law firm. True or false? False. Doesn't matter if she's a Florida registered paralegal, the lawyer is ultimately responsible. Number 6, a firm consists of 3 attorneys, but only one is a signatory on the trust account. The firm does not need a trust account plan. True or false? False. If there is more than one attorney in the firm, whether or not they are signatories, you need a trust account plan. Number 7, ATM access and overdraft protection are prohibited. True or false? False. Overdraft protection is explicitly prohibited by the rules. ATM protection, well, you wouldn't be meeting your documentation and record-keeping requirements if you have ATM access. Never mind that no one should have a debit card with unfettered access to the trust account. So that would be, you violating your fiduciary responsibilities. So it is false for all intents and purposes. Number 8, bank charges may be assessed against the trust account. True or false? So true, you can assess them against the trust account because if they are assessed against the trust account, you have law firm funds. That small amount, the auditor's suggestion is $200. Again, that's a suggestion. It depends on the number of transactions you do, the number of checks you order. So it is for you to determine what is reasonably sufficient to maintain in the trust account. But again, just be mindful, the recommendation that we will always give you is to have those charges assessed against your operating account if your bank permits it. So make sure you ask that question even if they don't offer it as a service from the onset. Section 3, we're getting to the fun part now. Record keeping and trust account management. So when we talk about an audit trail, we are talking about what the rules require, but it's also more than that. So if you checkbook, any checkbook register you have, you want to keep all of that, even though maybe it depends on stubs. That's not necessarily required by the rules, but you want to keep that. Any invoices you have, you want to keep that. So an audit trail is just a series of records that make it possible to trace where the money came in, where the money went, and it also helps you track down accounting errors. So at the end of the month, like Elizabeth said, you should be able to catch embezzlement if you're doing everything right within that month period, because you will have gone back, looked at all your records for that month when you're reconciling your account, and you should be able to catch any inconsistencies or discrepancies in what you see is disbursed versus what's actually in your account and what you have on your journal and on your ledgers. So it's just a way for you to follow the money. So the more records you keep, the better. You're not limited to just those records required by the rules. The best audit trail you can have is always going to be one that goes above and beyond what's required by the rules. Again, not required necessarily that you keep every document under the sun, but if you have it, keep it. Why not? It's an audit trail. Here are what the rules require. I'm going to go over them briefly, separately going forward, but here's just a list: receipts and disbursements journal, client matter ledgers, bank statements, deposit slips, and canceled checks, monthly reconciliations and comparisons, electronic transfers, journal of other properties, other documentary support. Anything can fall under that. Annual listing, written trust account plan, which we already talked about. So a receipts and disbursements journal, you want to think of this as your checkbook register. It is the chronological record of every trust account transaction. So every penny coming in, every penny coming out, you record it. I would suggest, we've had this call before frequently, when should I date the transaction on my journal? Should I wait till the check is actually posted into my account? Should I wait to the day I receive it? I would suggest you put it in your journal the day you receive the check. You record that transaction immediately, because if you wait until you actually deposit that check, or if you wait until it is posted to your account, you might forget, and you may never put it in your journal or your ledger, and then all is forgotten and nothing will balance at the end. So you want to make sure that you keep a running balance every single transaction. The Receipts and Disbursement Journal also shows a running balance of the trust account funds you're holding for all clients. So the amounts in the whole account for all clients. The journal must include columns for receipts, disbursements, and transfers, account balance. It must identify the client or matter. You obviously have to have a date, the check numbers for all disbursements, and the reason for the transaction. Again, think of it as your checkbook ledger. You're not going to go back a month or two and remember why you dispersed $25 if you don't keep that information. So not only is it required, but it just makes sense. Attorneys are smart, but they don't remember things forever. So you just do it for yourself. If you want to include a phrase in there to jog your memory, by all means, anything that can identify that particular transaction, include it in your journal. Client matter ledgers, similar to a journal, but I would say it's more of a micro view, client view only. It's a chronological record of every trust account transaction made on behalf of a specific client or matter. So where the journal holds every transaction for all clients, each individual client has its own ledger chronologically, every transaction. So if a client calls you and asks how much money you're holding for them, you don't have to look through your journal and parse out every transaction. You can just look at that client matter ledger and immediately tell them how much money you're holding on their behalf. So you must have one, like I said, one for each client. Only transaction specific to that client, shows the balance. Ledger must include, like the journal, receipts and disbursements or transfers, unexpended balances, so a running balance. You must identify the client or matter, date of transaction, check numbers, and reason for transaction. So again, it somewhat mirrors your journal, but it is specific to that client or matter. Bank statements, deposit slips, and canceled checks. So canceled checks, I just want to make a note of what canceled checks are before I go forward because I've had this question. A canceled check is not a voided check. A canceled check is a check that the bank has deposited, settled, and it's posted onto your account. It is not a voided check. We've had this question before. No, every check that you write out is a canceled check once it's been deposited into the party's account, whatever. Deposit slips. So a deposit slip must be an original or clearly legible copy if you don't have the original. Must include all the data on the original payment, which includes the name of the client or matter, date, source of funds. Auditor's suggestion is that you keep a copy of the check deposited. Sometimes deposit slips, if you go to the bank and you don't fill them out correctly, they don't have the space for you to include the client name or for you to include the matter name. You know, it's just a deposit slip where you put the amounts of each individual check deposit and then the total of the deposit. That's not going to be enough. So you want to make sure that you put all of the required information on your deposit slips. Otherwise, you're not compliant. Electronic transfers. You must have documentation for all electronic transfers. We've gotten this question a lot. Just because transfers online sometimes don't come with a receipt or come with the proper documentation doesn't mean that you must not keep that documentation. You must include the name of the person authorizing the transfer, the name of the recipient, confirmation from the bank, confirming the number of the trust account from which the money is withdrawn, and the time and date of the completed transfer. Wire transfers are permissible with proper documentation, and ACH is also permissible, but not recommended, and I'll tell you why. We know that you have to set up ACH accounts for the Florida Courts e-filing portal, and that is, again, permissible, but we recommend that you instead set up an ACH account using the lawyer's operating account and have the charge run as a client cost advance. ACH transactions generally don't provide the adequate documentation about disbursements, and unlike wire transfers that are individually reviewed and available the same day, ACH transfers are swept and generally can take anywhere from a few hours to several days to clear and settle. And also, ACH transfers can be reversed, unlike wire transfers. So a reversal means that someone other than you has caused money to leave your trust account, and that can be problematic. And often money initially received via ACH has been disbursed. So if that charge is reversed, now you've taken money from other clients, or worse, overdrawn your entire account. So while you can do it, you want to make sure that you are careful where you set up ACH accounts. Journal of other properties. Elizabeth touched on this earlier. You may not always receive money. You might receive jewelry or other property. You have to document that because just like the money, it is not yours. So you still have a fiduciary responsibility to keep that separate from all of your property. You must show who you're holding it, what you're holding, the date received, the date distributed, and to whom it was distributed. And it's also a good practice to get professional appraisals, photographers, descriptions of the client property. And Elizabeth kind of mentioned this at another presentation that I attended. Be careful what you agree to take. You can, if you get asked to hold, a bag that you have not looked into, it could have drugs in it. You don't want to hold contraband or any other instrument of a crime. So before you accept to hold any client property, make sure you open the bag and that it's something you can actually hold for the client and properly document. You don't want to be holding drugs for your client. That's just not good.
And just to add, make sure you label it, whatever it is. I mean, a lot of times when you receive other property, it's not self-identifying. So make sure if you're holding something in a safety deposit box, it's labeled with the client matter, the date it was received, et cetera, so that you know what it is. I mean, you might not see it again for a while, and you might not remember that exact thing.
Take pictures. Documentary support for all disbursements or transfers that indicates the name of the person, name of recipient, confirmation from the bank, so on and so forth. So other documentary support, like I talked about. Oh, you have a question?
Yeah, just going to that, and this might sound like a stupid question, but when you refer to other property, are you talking about, for instance, items like evidence that the client gives you at a console?
It could be, because that's not your property. That's something that belongs to someone other than, yes, anything that belongs to somebody other than you, which is going to be pretty much everything. Other than the file you create on behalf of your client and your own furniture and your own computer, it's anything. And again, do be careful, because I can't even tell you the number of lawyers I've talked to on the hotline where somebody just dropped something off of their office and it ended up being contraband or literally the smoking gun, and and then the lawyer's in a much worse position. Do not accept and properly train your support staff. Do not take stuff that you don't know what it is and that you can't properly account for.
Other documentary support. So I kind of talked about this earlier. The best audit trail is more than just your receipts and disbursements journal, your ledgers, your reconciliations, your checks, your deposit slips, so on and so forth. You want to keep check stubs. You want to keep invoices and receipts from vendors and service providers for costs expended on behalf of the client, signed internal check requests, and important, your own invoices to the client. You want to be able to show that this is what you billed the client. Hopefully it is a good invoice that fully describes the services performed, itemized, and with a total on it. And that total should match a disbursement from the trust account to your operating account. So again, documentation, documentation, documentation. That's one of the key concepts we talked about in the beginning. The more documentation you have accounting for every penny in and out of the trust account, the better positioned you are. And honestly, your likelihood of ever seeing Carl goes down a couple notches. So again, just keep everything to support where every penny came in, where every penny went out, everything. Just keep it. If at the end of 6 years you decide you don't need it, well, then that's on you. Minimum trust accounting procedures. So the rules require that you do 3 things. The reconciliation, the monthly bank reconciliation, the monthly comparison of the reconciled bank balance with the client ledgers, and the annual listing of the client balances. We're going to go over that very simplified version of that in a moment here. Example journal and ledger entries. So you'll see here that, like I mentioned before, there's a column for receipts, disbursements, or transfers. There's a column for account balances. There's a column to identify the client or matter. Date, obviously, check numbers for all disbursements, reason for transaction. Very basic view. Again, looks like a checkbook register, kind of. And it has all of the required information. So you've been hired by a new client to negotiate and prepare a vendor contract. Pursuant to your fee agreement, Client C gives you a $3,000 check for advance fees. You determine that the funds cannot earn beneficial interest for the client C, meaning they go into your own IOTA account. And that February 5th, 2020 entry is put into your, receipt is put into your input into the client journal or the receipts and disbursements journal. So you see there I have other receipts and disbursements. Above that, the running balance is now, after the $3,000, is now $6,756. Now this is what it looks like on the client ledger card. It's a new client, so you started a new client ledger card. This is the first transaction, which is the $3,000 advance fee. Again, it resembles the journal, except it is specific only to that client, and therefore that running balance is only $3,000, not $6,756. So if you're holding money in your firm's trust account for 10 client or matters, you have to maintain 10 separate client matter ledgers. Each individual client or matter must be treated as a separate trust account. That was key concept number one. So if this is client C, you presumably have client A ledger card, client B ledger card, so on and so forth. If you're holding your own firm funds to cover bank fees or charges, you have a ledger card for that. There's also an instance where some banks will include or will show the interest accrued on the bank statements. Some bank statements don't show it at all, and you never see interest accrued. If you do, if it does calculate the interest accrued, which eventually goes to the Florida Bar Foundation on your bank statement, in order for all the numbers to add up, you may want to consider having a ledger card for that interest and just keeping track of it, so when you go to balance and reconcile, everything isn't thrown off by that interest. But again, some banks don't include that interest at all on the bank statement, so it varies. Yes, you have a question?
Sorry, if you have a client that has, let's say they have 5 different LLCs today, they operate. Oh, sorry. You have a client that has 5 different LLCs, and you want to create a client ledger card for the client. It's going to be something where you're not getting a lot of money. Maybe it doesn't matter how many times you're going to get money. Do you need a separate ledger for each LLC, or can you have the master client at the top and have appropriate reference to the LLCs?
How do you like to see it, Carl?
Well, I would say if the one client has 5 LLCs and you can keep track of, all the money for you're performing one service or matter for them, you can keep it in one ledger. But I would suggest if it's very, a lot of transactions and it's kind of separate matters, you may want to consider 5 ledgers. So either way is acceptable. Whatever is probably the easiest way for you to keep track of it.
Thanks.
Yeah, again, if you call our office, we'll always tell you preferably that you keep, even if it's the same client, if you have 5 matters for that client, that you keep 5 separate ledgers. Again, it'll make it easier on you. Yes, you can keep one master ledger, but that will require you then to go back at some point and see what you've done for which entity or for which matter. So it's a matter of making it easier for you. Yes, at the onset, you may have those additional steps of creating additional ledgers for the one client, but in the long run, it makes the record-keeping process much cleaner if you have separate ledgers. So that would be my suggestion. Now we're dispersing funds. This is what it looks like in the journal. Here we are paying ourselves. We issued an invoice for legal fees, and we are paying ourselves $1,500. So this is what it would look like in the journal. Again, it's a disbursement, so you subtract from the previous running balance. I know this sounds obvious, but we get this question a lot. Disbursements are subtracted from the running balance. Receipts are added to the running balance. And you must always have that running balance. You can't just add and subtract in your head. So again, keep the balance, add, subtract, put in the transactions the day they occur in your office, not the day you go, a week later when you finally go to the bank and deposit a check. The day that you receive a check is the day you want to make sure you input that information on your journal or ledger. Same thing when you disperse funds. The day you write the check, that's the day, not the day that they finally receive it because you finally got the tracking information back and you know that the client received it, not the day that it comes out of your account. Go ahead and put the same day you issue the check, go ahead and put it in your journal entry and just, again, verify that it gets deducted from your account a couple days later, but the sooner you put it into your journal and client ledgers, the more likely you are to keep accurate, up-to-date records. All right, so here's what it looks like on the ledger. Again, this is a micro view of this specific client's transactions only, so it is the same transaction that you just saw on the journal entry, but now you have a much smaller running balance because, again, specific to this client, you started out with $3,000, you paid yourself $1,500, now you have $1,500 on the client ledger. Now this gets a little more convoluted. On the 17th, the client calls you at 5:45 to ask how much money you're still holding on their behalf. Normally, your secretary answers these questions, but they've left for the day. But you've kept detailed records, and you are able to communicate to client C that you are currently holding $1,500. Why? Because you have accurate records. You put it in your journal, you put it in your ledger. Due to some unforeseen delays, the vendor was not able to execute the contract until the 28th, at which point the matter was concluded and client C was sent a final invoice on the 29th. The 29th happens to be a Saturday. You also, along with that invoice, send a refund check for the unexpended balance. So in there, it's on the 29th. You'll see the transfer to operating for the invoice and the unexpended balance got returned to the client because that's what you agreed on in your written fee agreement, that any unexpended balances would be returned to the client. So those are those two entries. But remember, the 29th is oh, that's what it looks like on the ledger. You zeroed it out, sorry. I skipped a slide. So when you zero it out, again, that's the ultimate goal. Final balance always equals 0. That was your goal. You've now closed that matter. You have concluded that matter. So we're going to reconcile next. Now that we've done all that, we've done our individual transactions, we'll reconcile. Monthly bank reconciliation is when your bank account statement is reconciled to your cash receipts and disbursements journal. The comparison is when your bank balance, which equals your journal, is compared to the individual ledger card accounts. Now, this is done monthly, not quarterly, not weekly. It's done monthly. And we often refer to this as a three-way reconciliation, not because that's what the rules refer to it, but because visually it makes more sense for attorneys to understand what a reconciliation and a comparison actually is. So a reconciled bank statement balance is achieved by adding or subtracting any outstanding balances. You'll recall that that last disbursement was on a Saturday, meaning it probably did not go through or was not attributed to the bank or collected by the bank until the following Monday or whatever it was. So we're going to call that an outstanding transaction. So we're going to subtract the $500 from what's actually on the bank statement for the month of February, and that will give us the reconciled bank balance. That reconciled bank balance is going to equal our journal balance. Why? Because on the 29th, on a Saturday, we input that information into our journal, and therefore our journal will read $3,756, whereas our bank balance will read $4,256. Subtract the outstanding transaction, now they both equal $3,756. Now here comes the comparison part. Your bank statement, your journal balance should all equal the sum of ledger balances. So that means you grab client A's ledger balance, client B's ledger balance, client C's ledger balance, and whatever firm funds you're holding, you grab the firm ledger balance, you add them up, and they should, you can say it. Okay. Okay. So all the client ledger balances must equal your journal balance, which then must equal the reconciled statement balance. So again, three-way reconciliation is what it's sometimes referred to, again, because it's those three sets of documents: statement, journal, ledgers. And they must all equal each other once they've all been properly balanced. Whew. I'm going to take a breather there. All right. Monthly bank reconciliation. So here's a visual, again, an oversimplified version of what a reconciliation should look like. Your bank statement balance, deposits in transit, outstanding checks. You'll see there that February 29 amount or check for $500. It equals the journal balance, boom, you've reconciled. Again, this is a simplified version. If you look on our website, you'll see that there's hopefully many more entries that you'll have to account for, but the concept is the same. Your reconciled bank balance equals your journal balance. Monthly comparison. All right, so here again is a visual of what a monthly comparison looks like. Client A's ledger amount, client B's ledger amount, client C's ledger amount, which has been zeroed out. The law firm's ledger, which is $200. Total client ledgers equals the journal balance equals the reconciled balance. Now, you want to make sure that you keep these documents together with that month's bank statement, deposit slips, canceled checks. You want to make sure that you keep all of that month's records, required records, together in one place. How you keep these, whether it's paper or electronic, is up to you. But you want to make sure that you keep everything in an orderly fashion, because again, if Carl ever comes knocking at the door, you don't want to sit there for hours trying to recreate records or pulling records from different places. So again, just be mindful that every month when you're performing this reconciliation, you should just keep everything together. If you have to staple it together, go ahead and staple it together. That's fine. Available for download. Everything we just went through in Excel format is available for download on legalfuel.com. So you'll have journals, you'll have the journal, the client ledgers, and the monthly reconciliation and comparison forms, again, in Excel format. So you want to make sure, if you are not familiar with Excel, that you give us a call. It's very easy. It just requires that you input the numbers. All the formulas are there for you already, so long as you don't mess with the formulas, it shouldn't be too hard. You don't need to be an Excel genius before that. Annual listing. Very quickly, requires that lawyers prepare, the rule requires that lawyers prepare an annual listing of unexpended balances held for each client or matter. Here's a visual representation of what that looks like. It's done every month. It's essentially the balancing of that final month's records. You want to keep unexpended balances that are going to then roll over into the next year for any money you're holding in the trust account. So client A, client B. Remember, client C was zeroed out, so we don't have a client C anymore in this particular annual listing. The law firm, total year-end ledger balances.
Okay, so there's a couple more concepts I'm going to fly through, so you'll have a chance to listen to Carl's war stories, which are fascinating, and also will be great warnings to everyone. So first of all, you are required, when you receive funds on behalf of a client or third persons, you must promptly notify them that you have received them. You also have to promptly deliver to clients or third parties any funds that they're entitled to that are not in dispute. You also are required to promptly render a full accounting to a client or third party when you have held funds on their behalf. That means you have to tell them when you got funds, when you disperse funds on their behalf, how much funds you still have. You have to say exactly what came in and out and when. And if you are holding funds and there is a dispute, I strongly recommend you call the ethics hotline to discuss with one of the attorneys on the ethics hotline what you should do about those funds. When you have, as occasionally happens, funds that you're holding and you either can't find the person, the client has disappeared off the face of the planet, or you can't identify, because you haven't been doing your monthly reconciliations like you should, you can't identify who the funds belong to, then you have to make a diligent search and inquiry to determine either the location of the owner or their identity. If you still can't, then you have to dispose of it in accordance with Florida law. That means it's abandoned property. There is information available to you on this slide, but also in the materials you will get. That's Chapter 717, the abandoned property section, and there is, in the Department of Financial Services, the lovely people you can deal with on how you deal with abandoned property. Not the Florida Bar. We are not, don't ever send your abandoned property to the Florida Bar. We will not accept it. We do not want it. Records retention, you are required to keep all trust accounting records for at least 6 years following the end of the matter to which they relate. Not the time the trust account record was created, but the end of the matter to which they relate.
We touched upon this briefly, but I will go over it again. Lawyers are required to keep an annual, or to certify annually whether they're in compliance with the rules. The trust account certification is included if you file or you pay for your annual fees online. You cannot make payment without completing this section of your fee statement with the bar. So if you've done it online, you cannot proceed without filling out this portion. The issue comes when you pay your annual fees using the paper form. A lot of times people skip that section and just send over their check and never fill out whether or not they're in compliance. They never check one of the boxes. So that is when you have to, in turn, call our membership records department and fix that issue. Why? Because it ends up in an automatic delinquency. So it's a very easy issue to fix, but again, if you do use the paper fee statement to pay your annual dues and you forget to fill that section out, you will likely get a letter you will be notified that you are delinquent, and you just have to call membership records and correct that issue or submit a separate standalone trust account certificate. There's a Section 3 review, but we're kind of running low on time, so you guys will get a copy of a handbook that we've prepared that pretty much mirrors this. It has that review in there, and it has all the answer keys.
May I ask two very quick?
Yes.
Okay. I know we're running low on time.
Sure.
It disappeared. Number one, I think you said earlier, but I wasn't quite clear. How long may you keep money in your trust account?
Well, you can keep it as long as it's relevant. So, I mean, but you have to deal with it promptly. So you
Right.
can't just hold settlement funds forever, for example. You have to promptly disperse them to the person to whom they belong. Sometimes there's a dispute over funds, and you have to try to resolve the dispute. And if you can't do it within a reasonable time, you may actually have to go to a court to get a court to tell you how to deal with the dispute.
Okay.
But you have to promptly get the money out of your account. So it can't just sit there for no reason forever, but as long as there's a reason, like you have a transaction that's still pending, then it's fine to have it there.
So what you just answered has now raised something else. What would the ethics hotline say that promptly and reasonably is?
It depends on the circumstances, like so
Okay.
many things in the law.
Okay, my next question, and kind of an interesting one. So you get a settlement check. You've settled the case, everything's done, and the settlement check comes in. But yet the client has not come in to sign the settlement statement. And then by the time the client gets there to sign the settlement statement, the check is now stale. So when the check first comes in, may we go ahead and deposit it into the trust account?
You can if
Or-
it's made out to you. If it's made out to you and the client, though, you're going to have a problem because you can't. You're going to have a problem because the
Okay.
client has to also endorse it if it's made out to you and the client, which a lot of
Right.
times it is when
Right.
it's an insurance company.
Right.
And they will sometimes put the predecessor lawyer and any other lawyer they think, or any other person they think might have an interest in the check. So if you can get the endorsements, yes, please do deposit the funds.
Okay, all right, thank you.
All right, and some key takeaways. Again, they kind of mirror the key concepts we discussed in the beginning. The lawyer is always responsible. It doesn't matter if she's a registered paralegal. It doesn't matter if they are a non-lawyer signatory on the account and they're on your written trust account plan. At the end of the day, the lawyer is always responsible. Separate clients or matters are separate trust accounts. So even though everything is held in a common trust account, you must treat them as separate accounts. You can never disperse more than you are holding for any given client. You can't spend what you don't have. There it is. You can't spend what you don't have in your common trust account. You can't spend what you don't have for any given client. There should never be a negative balance. Again, it goes back to the same point. You can't spend what you don't have. If you don't have it and you spend it, there will be a negative balance, which means you've overdrawn the account, which means you're in trouble. Timing is everything. This is important because you need to know what your bank policies are when they post, what available balance means, you need to know when everything is posted into your account, when you will be credited, when you will be debited. So you want to be mindful of your bank's posting policies and collection policies. Always know balances. If you keep accurate, up-to-date records with that running balance column and you subtract disbursements as they are dispersed and you add receipts as they are received, then you should always know the balance, and your client can call you at any time of day and you will be able to tell them that balance. The final score is always 0. Again, the goal in trust accounting is to zero out your client ledgers, to disperse all funds that you're holding for any particular client. You never want to be in a position where you forget who the client is or where that client has passed and you have to go through this whole process to turn the funds over. Try and deal with the funds as quickly and as reasonably as possible. I mean, honestly, there's people that sit on client funds for years. We've had calls of someone saying, well, I've had these client funds for 7 years and this client has moved, I don't know where they are. You have to dispose of them according to the rules, but again, if you would have just disposed of them promptly after the conclusion of a representation, you wouldn't be in that position. So again, always zero out your client ledgers as soon as possible. Go for it. Always maintain an audit trail. Again, you have certain required records, but it goes beyond that. A good audit trail will require that you maintain records beyond those which are required. So documentation, documentation, documentation. It was a key concept in the beginning, and it will remain true throughout this whole presentation. All right. And we break very quickly. Practice Resource Center, Ethics Hotline, Attorney Consumer Assistance Program, ACAP for short. Those are the phone numbers. Know them, love them. Call them if you have any questions. We're always here to help, and we will be back shortly with Carl's presentation.
All right, I'm going to tell you a little bit about what I do as an auditor and the process involved. So when the Bar Council gets a case and there's an issue with the trust account that may need further investigation, that's where I get involved. So basically what a compliance audit is it's an examination of the trust account, and it's through by verification of the accounting records and the supporting documents to determine whether or not the records and procedures are in compliance with the Chapter 5 rules. And my main focus when I do a trust account audit is it relates to the financial transactions. It's a subject matter of the complaint or the notice from the bank, which I'm going to get into in a minute. But just keep in mind that the compliance and the requirements for the Chapter 5 rules, as we discussed before, it's basically the lawyers or the respondents' responsibility to be in compliance. Now, in Florida, so this is something you may like to hear. We don't do random audits. I don't get out the phone book or a list and say, we need to audit this attorney. The complaints come in primarily two ways. We'll get a complaint from a client, or we'll get a notice from your bank that where your trust account is maintained. And basically what happens there is the bank will send us a letter saying that the trust account had a check returned for non-sufficient funds, or the account became in an overdraft status. So when we get a complaint or a notice from the bank, that doesn't necessarily mean or guarantee that there's going to be an automatic compliance audit of the trust account. What I'm going to try to do is I'm going to try to figure out what happened. And what we'll do is the first thing that's going to happen is when we get a complaint or a notice from the bank, the Bar Council is going to send you a letter. And the letter is going to ask you to explain in writing what happened and to attach any supporting documents that corroborate your explanation. So just make sure whenever you get a letter from the bar, just make sure that you always respond to the request, because if you don't respond, the Bar Council is just going to end up sending you another letter and eventually file a contempt action and suspend you until you file a written response. So, nobody wants that to happen. So after I review the responses that you provide, what I'm going to do is I'm going to try to ask myself, do I have enough information here to determine what transpired? And to get to the bottom of that, your response may have that clearly noted, but sometimes I might need to ask you for some more records, just to focus on the key matter. And we'll also send a letter to the complainant asking them for some more explanation and some more records to try to determine, what transpired. Can we conclude it? But sometimes, just looking at the records that you gave in the response, it's necessary to do a full audit of the trust account to get to the bottom of it, because unfortunately, sometimes some people just respond by giving a letter and saying, I corrected the mistake and everything is fine, and they don't give you any records supporting it. So that's kind of a red flag that we need some more records to get to the bottom of what happened. And as you probably know, just because you get a complaint from a client of yours, that doesn't necessarily mean that you did something wrong. That just means that we need to investigate what happened, because sometimes you get a complaint from a client and it amounts to nothing because they don't really understood what was supposed to happen, how it was supposed to happen. They don't like the way they don't like the end conclusion of their representation, so they're kind of sore at you, maybe for, not the right reasons, and they want to just file a complaint. So when I actually do perform a compliance audit of the trust account, I don't call you up or show up at your door. I do that through a subpoena, and I issue 2 subpoenas. I'm going to issue 1 subpoena to the lawyer respondent for all their required trust accounting records and procedures, and I'm going to issue another subpoena to the bank. And the reason I do that to the bank is because I'm going to get all the records of every transaction and everything that happened in the trust account, because as you will see, a lot of times, for whatever reason, the attorneys, they don't keep all the records that they should maintain, or if there's a problem, they thought, well, if I don't give you this, you won't be able to figure it out. So when we get the records from the bank, I'm going to know about every transaction that happened. So at the end of my audit, what I'll do is I'll prepare a report that'll be called a compliance audit report. And if it's called the compliance audit report, that's just going to be a report of the record-keeping violations, a report where the findings are not all that serious. But unfortunately, sometimes attorneys do misuse or steal their client funds, and in that case, I would file an affidavit of emergency suspension, and then the Bar Council would file a petition for emergency suspension because of clear and convincing evidence of theft of trust funds. And sometimes, that case may end up in court, and I may be called upon to testify in court. Basically describing what I did in the audit, my findings, and attaching, as exhibits the relevant evidence. So the next thing I'm going to talk about is a little bit is when I do the subpoena, the records and procedures that I ask for, and some of the other rules that I focus on and consider during the compliance audit. So a lot of these things, these other 2 ladies went into in depth, so I won't spend a lot of time on it. I'm just going to let you know that these are some of the things that I ask for. And just remember that these records, these are the requirements of the Chapter 5. It's just not something that I'm asking for because I'd like to see it. So things that I would ask you for in the audit is your bank statements, your deposit slips, canceled checks, your other documentary support for all disbursements and transfers from the trust account. Now, remember, this is a really important rule, because sometimes a lawyer will say, well, I gave you the other documentary support. I gave you the bank statements and the checks, but we want the records that are beyond that, because the bank statements and your canceled checks, yes, those are required, but what the other documentary support in the summary is the documents that explain what you're supposed to disperse to the client. For example, your closing statements, a HUD-1 settlement statement, a retainer, a fee agreement. These documents will substantiate what's not only due to the client, but what's due to you for your attorney fees, what's also due to you for costs, the amounts that would be due to other third parties like medical providers or filing fees, etc. And remember that these records, the other documentary support, this isn't something that we can subpoena or get from the bank. These are documents that are created or generated by the attorney. So these, in a nutshell, the other documentary support, why it's so important is because these are the source documents that explain the reason a disbursement was either made to the client, to the third party, or to yourself for fees and costs. Some of the other records that I would ask for would be your wires, ingoing and outgoing wires. The receipts and disbursements journal, which was explained in depth a little bit earlier. the client ledgers, which reflects the deposits and disbursements and the unexpended balance for just one client. We talked about this earlier. This is something I'm going to ask for. Generally, if there's more than one lawyer in a firm, like when there's partners, the written trust accounting plan. And one of the reasons I think this rule came into place, because sometimes, unfortunately, when there's missing money and there's partners, each lawyer says, well, he did it, she did it, they blame each other. So this kind of just spells out who's responsible for the trust account. Other records I'm going to ask for is the monthly bank reconciliation, which we kind of went over, and they showed a nice example earlier. The monthly comparison, which is another record where you take the monthly bank reconciliation a step further. Yeah, we talked about this too. I mean, always the importance of an audit trail is really important. Just keep this in mind in a nutshell. For all your deposits, be able to explain, and identify on the deposit slip what client matter does it relate to, the name of the client matter. The same for all your disbursements, whether it's a check or a wire. Be able to identify the name of the client or the name of the matter by name or number, whatever the case may be. The records, as we talked about earlier, you need to maintain them for 6 years, so I won't ask you for 7 years of them because you're not required to keep them per the rule. And just remember that a trust account, in essence, is a liability account. And what I mean by that is there's a liability for all the funds deposited to be paid out to somebody, whether it's the client, third party, or to yourself for fees and costs. So sometimes mistakes happen. So if money it gets deposited into the trust account by mistake, once you discover that mistake, get out of the trust account and put it into the account that it should have been placed in, probably your operating account, or whatever the case may be. Just something else that I've observed over the years, whenever I do a compliance audit and I get records from an attorney, the majority of time there's usually only partial compliance, and it seems like the monthly bank reconciliations and the monthly comparisons are the two things that I don't get, because those do require some work and some effort to prepare those. So I don't know, I think maybe people don't like doing them, or they find it difficult, or it's just extra work, but they are important, because by doing those two reconciliations, you're going to know at the end of the month or any given time if a mistake happened or there's money missing. We talked about this earlier, don't commingle funds. So basically, don't take your client's funds and deposit it into your operating or your personal account, and just the opposite. Don't deposit your own personal funds into your trust account, except for, you can keep a minimum balance to cover, bank fees and wire charges and so forth. Some other rules that I'm going to consider and look at throughout the audit. This rule, 5-1.1B, application of trust funds or property for a specific purpose. This rule, I find, to me, is the most important rule in Chapter 5, because the violation of that rule is a rule that can end up getting you, potentially in trouble, because that's the rule you got to follow in the sense that when you get money in trust, you got to apply it and spend it is exactly how it was agreed upon in writing. So if you do something different, you could have a violation of that rule, whether it's purposely or unintentionally. Just, remember to keep in mind that client A's money has nothing to do with client B's money, even when you keep them in a common trust account. The ledger cards are going to help you distinguish one client's funds from another client. And remember, too, that there should be no such thing in a client ledger as a negative balance. And what I mean by that is you can't have you can't have disbursements for one client exceed the related funds on deposit, or you're going to have a negative balance. Either you made a mistake that you spent too much by accident or you didn't get enough from the client in the first place. I was just talking about this, earlier. You can't spend what you don't have, even if you have $100,000 in your trust account and you're holding $100 for one client. You can't write a check for $105 without either spending another client's funds or some of your own funds out of your small balance. That whether it's $200 or $300 that you keep in the account for the bank charges and fees. Here's something I wanted to touch on that's important, because sometimes you're going to accept deposits by credit card from a client because it's kind of easier for them. But just remember that every time that you take a deposit and you deposit in your trust account from a credit card, the bank is going to automatically take a slice of that as their fee. So if you take $500 in your trust account and you know you need $500 to pay for a filing fee, my suggestion to you is work it out with your bank that they deduct all your fees and bank charges from your operating account so you don't have a shortage in your trust account because of those credit card fees. We touched on this as well earlier. Safeguarding your clients' funds and accounting for them with the rules is your personal fiduciary responsibility. Remember, too, that you must provide, as the attorney, adequate training to your employees, and you got to supervise their work. You got to look at what they do regularly. What I mean by that is look at the monthly bank reconciliations and the monthly comparisons each month. Just let your staff, whether it's your assistant, secretary, or paralegal, whoever's doing it, let them know that you're looking at it. Because in the end, as the attorney, you're going to be responsible for any shortages or deficits or overpayments from the trust account. And what I mean by that is a shortage in the trust account, in essence, there's a deficit of funds available in the bank versus what you should be holding in trust. So at best, a shortage is negligence because, a careless mistake was made, or at worst, there was, an intentional misuse of funds. And we talked about this earlier, so you can't use the automatic, overdraft protection to eliminate your shortage because that's against the rules. If you have the automatic overdraft protection, in essence, that's commingling because you're telling your bank or authorizing them to take funds from one of your other accounts, your personal accounts, to cover the trust account. So one of the most effective precautions you can take as the lawyer, we talked about this as well earlier, get the bank statement unopened and review it. Look at the canceled checks, look at the disbursements on the bank statements. Inquire, ask whoever is preparing your records if it isn't you, what was this disbursement for? I don't recognize this name. Which client matter was it for? That way they'll know that you're on top of it. And one thing about the bank statements, basically that to me, that's the only document which is going to show any thefts in the trust account, if there's any. Because you could have somebody doing your books and they can say, well, here's the reconciliation, here's the journal, here's something that they prepared. Somebody that's being dishonest, they can manipulate those records and documents to show you anything that, looks good or serves their purpose. But the bank statement's never going to lie. It's going to tell you all the money that was deposited. It's going to tell you about every transaction that was dispersed from the trust account. I'm going to talk a little bit about a couple cases that I'm familiar with at the bar. The first case was the Florida Bar versus Roth Russo, and in this case, there was a trust account shortage of approximately $4.38 million, and the partners said, okay, well, we had a non-lawyer bookkeeper, and that person embezzled the funds. But like these other ladies were telling you about earlier, you're responsible as the lawyer. Even though the court determined that the lawyer, both partners, that they didn't put any of those funds in their pocket, they didn't receive any benefit, they still ended up being disbarred because of that. This next quote I want to read to you. This is just not my opinion or my view. This is a quote directly from the Supreme Court's case law, and this is their position on it. Clearly, the ultimate responsibility for the trust account rests with the attorneys. A lawyer's responsibility for safekeeping of trust account funds cannot be delegated to a non-lawyer employee of the firm. Misappropriation by office staff does not relieve the lawyer from the requirements of the minimum standards of the trust account. So that was right from the Supreme Court judges, so it doesn't get any more authoritative than that on their view of it. And as well, another case, this case is one that I actually worked on. It was the Florida Bar versus Gilbert. You know, it's similar in the sense that there was a trust account shortage of approximately $4.7 million. And the facts of this case demonstrated that the respondent, you know, the attorney, he didn't exercise any supervision over the non-lawyer. And the non-lawyer that he hired was a convicted felon that stole $7 million from his former employer in another state. But this attorney decided to hire him anyways because he felt he could help me with my real estate practice and I'm going to make a lot of money. So he just kind of looked the other way and let this guy roll with it. And over a 4.5-year period, you know, $4.7 million were stolen. But, you know, you may say, well, wow, how could somebody steal that much money over time? And what he did is, the main thing he was doing is when there was a mortgage, a prior mortgage on a real estate closing to be paid off, he took the money and put it in his shell company. And now, so nobody was complaining. He had an assistant, you know, he hired a young teenager, a college student, run to the bank for him and what he would do is he'd keep making the mortgage payments on the prior mortgage, so nobody's calling and nobody's complaining. So that's what perpetuated it, but eventually that's not, you know, that can't go on forever, and somebody, you know, eventually started complaining, and that's how we got involved and started investigating that. This lawyer, you know, ended up being disbarred, even though, you know, the court didn't see where he benefited from any of the funds. Another case that I worked on this case as well. This is a case, it's a recent prosecution. Actually, it was a few years ago, but the complainant was a lady who was not even a client of the attorney at all. And what she did is she gave a $32,000 deposit for a condo to a real estate developer. And because the condo was never completed, she asked for a refund of her $32,000 deposit. So what happens is you have an attorney who has a client, I'm just going to call him, you know, Mr. K. And what he did is this attorney's client intercepted the lady's refund check from the developer because he went into the developer's office because he was acquainted with somebody there, and he says, you know, well, the developer owes me money, so I'm going to take this check. And he just, you know, walked out with it. You know, it wasn't real clear how he did it, but he managed to walk out with this lady's refund check. So what he does is he goes to his attorney, who he does a lot of business with, and he has a check that's made out, Mr. K has a check that's made out to a lady, and he can't deposit in his own bank account because his name is not on it. So what does he do? He goes to his lawyer's account. He goes to his lawyer and says, okay, can you deposit this check into your trust account for me? And the respondent, the lawyer in this case, says, well, this guy's a good client. His business accounts for like almost half of my revenue a year. So he deposited the $32,000 check into his trust account. And per his client's instruction, Mr. K, what he did is he dispersed the lady's funds through 3 different disbursements equaling the $32,000. One of the disbursements was 31 that went to Mr. K, so really he got the majority of the lady's funds. So what happened in the end is the judge found that this is misappropriation because even though the lawyer didn't put any of those funds into his own, into his own pocket or benefit from them, he dispersed the money for the benefit of somebody that wasn't entitled to the funds. So the judge found that that was misappropriation, and the court ended up disbarring him. And afterwards, both Mr. K, the client, and the attorney were arrested by the state attorney's office. And that's all I have.
Well, thanks. So we've got the last little session here. I promise I'll make this short and sweet so that we can end on time. We've just spent 2 hours listening to Carl, Elizabeth, Carla, just talk about the rules, the requirements, so a whole lot to absorb there. I'm going to transition it a little bit to, move away from the rules, the requirements, and then let's talk about how we could look at putting those rules and requirements and following through in the real world. And to give you a background, I'm one of the co-founders of TrustBooks. TrustBooks is trust accounting software built for small law firms. That is our niche, small law firms and helping them with their trust account. And just to give you a little bit of a background on how we kind of got into trust accounting software, because I'm sure it's not the most riveting. It's not that's the software I want to build. So I'll give you a background. I'm a CPA. I was having a CPA practice that worked almost exclusively with law firms. And a lot of the challenges of implementing the rules and requirements that we talked about for the past 2 hours, those were the challenges I faced when helping my law firm clients. I was using QuickBooks. I was using Excel. I was using practice management software. And I was trying to get these different pieces of software that aren't necessarily built for trust accounting, and I was trying to get them to work for a lawyer's trust account. And so as I'm kind of a couple years into my CPA practice, I talked to my co-founder and we start brainstorming on there's just got to be an easier way. Carla, you mentioned that at the beginning, you don't have to be a CPA to understand the rules and to follow the rules on trust accounting. And that was kind of the approach that we wanted to take. We know QuickBooks and Excel, they exist out there. They exist really for accountants. But these small law firms and that market is kind of the underserved when it comes to just how can you easily manage your trust account and follow the rules, follow the requirements. And so that's what we set out to build. We wanted to make it super simple. We wanted to give it an easy platform to just go in, manage your trust account, get to the statement of the receipts and disbursements. We call that a trust ledger in TrustBooks. Make sure you're always maintaining client ledgers. Make sure you're never going to be able to deficit spend on a specific client balance. And then get to that monthly, we call it the three-way reconciliation in TrustBooks. And it's just by default of using the product. And so what I'm going to do here in the next 10, 15 minutes is just walk you through exactly what TrustBooks looks like, how you would use it, and how it's going to help you stay compliant with the rules and requirements that we just listened to. So what you're seeing on the screen here, this is our dashboard. And for us, this is the central hub for managing your trust account. And by taking this ground-up approach to trust accounting and building software for the trust account, we were able to strip away a lot of the noise that you typically get with accounting software. So instead of trying to build this product for all things, for all people, all industries, we're taking that laser-focused approach to saying, you know what? How do we build something just for a lawyer's trust account? And all that extra debits, credits, chart of accounts, balance sheets, payroll, all that other stuff that you typically see, it's not part of our product. It's not who we're focusing on. And so as we look on this dashboard, at the top, I've got my firm trust account with my balance. That's going to be my overall balance in my bank account. So that, and if I go and click on it, this is going to show you that what in the Florida rules, they call it the receipts and disbursements journal. We call it a trust ledger, but this is at the high level, showing you all of your activity in and out of your trust bank account. Scroll back to the dashboard, scroll down, and we've got matters, deposits, payments. Pretty simple, right? And it mirrors that same workflow that you see in a law practice. New client comes in the door, that's a matter. Money goes into the bank account, it's a deposit. Money leaves the bank account, it's a payment. That's simple. And by building it from the ground up with focus on trust account, I'll show you how just on the deposit page, when you process a payment, by default of using trust books, we're going to automatically create those client ledgers that you always need to maintain for good trust accounting. So let's say new client comes in the door. I'm going to go create matter. I've got 2 required fields. I've got client name, matter name. It's that simple. I don't have to overthink it. Once I've set up a client, now if I go back to the dashboard, I can go to my view matter list. Before I jump in there, my view matter list is going to show me all of my active clients. What's important about this is we talked about wanting to know, here's how much I've got in the bank account at a high level, but I need to know at any given time what my balance is on a client-by-client basis. So even though I've got $60,475 in my bank account, now let me go to my view matter list, and I'm going to see how that's broken out on a client-by-client basis. So each one of these are my clients, or my matters. Matters and clients are synonymous. And I can see this current balance column, exactly how much money I've got on a client-by-client basis. So we were talking about knowing at any given time how much money you've got. This is showing it to me. Now, taking it a step further, we have to know our client ledgers. We have to know, how much money, the ins and outs, the deposits and the payments for each individual client. So all I have to do is let's go Danny Reagan here. You see any Danny Reagan fans? No? All right. This is going to show me my client ledger. It's going to show me all my deposits, all my payments, my running balance. So at any given time, I know exactly how much money I've got in my trust account on a specific client balance. The other thing, since we're built for trust accounts, we've just got, one-click buttons to make your life easier. So if I want to, I can go right here and hit Print Matter Ledger. It's going to open up. It's just going to open up a little bit more formal PDF. I've got Pearson Spector Lit. Hopefully that resonates, right? Yay. Is my law firm. And then this is going to give me a little bit more formal client ledger that I can easily hand off to my clients, save for my internal records, whatever I need to do with it. All right, so that's on the kind of client ledger side. If I go back out to my dashboard, I'll show you how easy it is just to put activity into trust books. I think one of the real challenges that lawyers face is just, it can be overwhelming. Where do I start? How do I get started using a QuickBooks, using Excel? I know we've got templates, which are great, but even the templates, you've still got to have that kind of understanding of how to use Excel. And I've yet to find that attorney that has gone to law school because they love to do trust accounting. So this is just kind of helping you navigate through that system. So let's go enter deposit. On this, again, it's straightforward. The first thing that you'll see is that we always have to select the client. This is part of our core principle. Because we're dealing with a trust account, we know that every single transaction, every deposit in, every disbursement out has to be associated with a client. With that in mind, that's just how we built the product. You don't have to overthink it. You just have to use it and say, you know what, let's go Tom Boyle. I'm going to say advanced court costs. Let me put in a check number, and let's say $500. Pretty straightforward. Let's say I had multiple checks that I put on one deposit slip. I'm just going to hit Add Transactions Deposit. Each check gets its own row. The reason why I bring this up is in our minds, we think about how do we make it easy to get back to the reconciliation step. So in our minds, when we built the product, we did it with the mindset of everything we do, we want to make it really easy to be able to reconcile as Carl said, that's one of the most common ways that attorneys are out of compliance is they just don't do the reconciliations. And so as we're thinking through this, all right, we want to make this a no-brainer. So this total, we want it to match your deposit slip total. We want that total to match how it's going to actually show up on your bank statement. The reason why, it'll just make your life easier to reconcile it back to your bank statement at month end. So that's recording a deposit. I'll get back out and I'll look at process payment. On this page, again, we start with selecting the matter first. Now here's the neat thing. When I select a client, you see that the available balance for that specific client automatically displays. We do that for two reasons. One, it just gives me a nice visual. I know exactly how much money I've got in my trust account for this one client. So even though I've got $60,000 in my bank account, I know I shouldn't cut a check for more than $1,400 for this one client. The other thing it does, we talked about this multiple times, you can't deficit spend on a specific client balance. So guess what? We put in a control because we're only focused on the trust account that won't allow you to deficit spend. Much, much different than Excel or other accounting software where they don't have this focus on trust accounts, and so you can put in whatever dollar amount you want. There's no preventative control. So let me just fill this out. I'll put in, let's say this is a wire, and let's say this is advanced court costs. We do have the ability to print checks. I know I put this in as a wire, but if I wanted to print this as a check, I could do that. I'll hit save just to highlight exactly what you're going to see if I try to deficit spend on a specific client. We're thinking.
It's the internet, not the software.
We're thinking. Yeah. Yeah, so our kind of sweet spot is solo practitioners up to like 10 attorneys. That's kind of our niche. Perfect. Yes. Go for it. Anybody can use it. Yeah, large or small can use us. We've got folks with, thousands of transactions a month. I'm just saying that our typical law firm is solo to small law firm, but we don't, we'd love if you're at a big firm to use trust books.
What is the cost?
Costs $39 a month, $390 on an annual basis. We are a member benefit with the Florida Bar, so we're $351 on an annual basis with our Florida Bar member benefit.
If we sat and listened to this today, do we get a discount?
If you're a member of the Florida Bar, you get a discount.
I mean, an additional.
Oh, I don't know. Talk to me. Yeah. Yeah, that's right. Cool. All right. So there's our inability to deficit spend. The software is going to say, nope, you can't do it. All right. That right there that we walked through, that entering a client, putting in money, dispersing money, that's how you're going to use trust books on a day-to-day, week-to-week basis. Don't have to overthink it. It's that simple, right? Client comes in, create matter. Money comes into the bank account, enter deposit. Money leaves the bank account, process payment. We do have integrations with CLE and LawPay, so that makes it even easier. With LawPay, you take credit cards, they go into the trust account. We will import that data in. All you have to do is go and find the right client, associate it, and hit import. It's that easy. Same with CLE. If you're putting all your stuff into CLE, we'll integrate with CLE so you don't have to do any redundant data entry. All right, so that is the functionality of using trust books on a day-to-day basis. Let me jump into the month-end process. That's one of the most important things to get right is just the reconciliations side. And really, that's how we were built from the ground up with this mindset of how do we make sure we can get to a three-way reconciliation. So if I go to perform reconciliation, I'm going to show you this too. Here's our bank statement. So let's walk through a real-world example of, here's our bank statement. We got a summary, we've got our beginning balance, all the checks and other withdrawals that happen, and then our deposits. So how are we going to do this and make sure that it ties into trust books, or make sure that you just can do a reconciliation? So first step, I'm going to look and find my ending balance per the bank statement. 104,900. I go over to trust books. I'm going to type this in, 104,900. Next step, I'm going to look at my bank statement, and I'm going to match. I always start with the deposits first. I don't know why, but that's just my mindset. So I'm going to start with my deposits. I'm going to match all my deposits that showed up on my bank statement to what I've recorded here in trust books. So let me go do that. Again, I'm going to look at my bank statement, and I've got all my deposits right here. And I'm going to make sure I can just go down 500, 350, 35,000, 2,500. Let's match those to what's been recorded here in trust books. 500, 350, 35,000, 2,500. A little checks and balances. So that's 38,350. That should match my bank statement. Let's see.
I think you have to add 2 zeros up top.
So,
There's a zero missing up top, I think, somewhere.
oh,
You're fine.
gotcha. Here we go.
There we go.
Boom. Thank you. All right. So I did my deposits, right? Looking good so far. Let's go do that same process with checks and payments. So I've got my bank statement. Cool thing about bank statements is you see the little asterisks? That indicates a gap in check sequence. That is, I'm going through and doing my reconciliation. That should be a red flag that, hey, I see a gap in check sequence on my bank statement. I know when I'm doing my reconciliation, I should probably be aware of that, and I'm probably going to have to skip over some checks. Those are going to be our uncleared or outstanding checks that didn't clear, and they're just going to roll forward to the next month. Super easy. So let's start check 3501, 3502. So you can see I'm already skipping this first one. That is outstanding. It's uncleared. I just don't check it off. Then I had that gap to 3505, 3506, 3508, and 3510. Perfect. Looks like I'm done, right? Not quite. Here's the other subtle feature, but it's important. This is us being zoned in on the trust account. We want our customers, our users, to do it right. The trust account is too important. So as I'm getting down here to this reconciliation summary, if your cleared balance, what I just checked off, does not match your ending balance per the bank statement, we do not allow our users to force a reconciliation. That means that there is an error. You have to go fix that error before you can finalize it. That it's important to us because we want our customers to get it done in the correct way. So my error is this 1250. Let me go look at my bank statement. Aha, here it is. I didn't include this other withdrawal, this transfer. So let me go check that off. Scroll back down to the bottom. Difference is 0. Ready to reconcile. I just did a reconciliation. Pretty easy, pretty straightforward. I'm going to hit save and reconcile. Once I've done this reconciliation, I can come under here to view reconciliations, and I can see what's been generated. So again, we're focused on the trust account. We generate 2 reconciliation reports for you automatically. The detailed reconciliation report, that's going to be your standard month-end reconciliation report that you're typically getting in accounting software. It's reconciling your bank statement to your trust ledger, high level. We also automatically generate a 3-way reconciliation. So let me open that one up. This is the all-important one at month end. And what are we seeing here? We've got a summary page. We've got our bank balance. Easy, I just pulled that straight from my bank statement. We've got a handful of those outstanding or uncleared checks. Those are going to be our reconciling items. That gets me down to an adjusted bank balance. That adjusted bank balance must match my internal records. So my 2 internal records are my trust ledger and the sum of my client ledgers. Perfect. 84,400, 84,400, 84,400. They all match. Scroll down to page 2 on this. And this is giving me the detail of those uncleared checks. So I've got that detail. Scroll down to page 3, and this is the important piece. This is showing me all of my clients with their balance as of my reconciliation date. So this gives me that nice confidence that, yep, here are all my clients with balances. The bar wants this, the rules want this, because one, it will prove that you're maintaining client ledgers, which you have to do. And two, if you're showing the balance, it will highlight if any of them are in the negative, which you can't do. The beauty of trust books is we just maintain client ledgers always, and you can't deficit spend, so moot points, but still, that's why the rule exists. The other thing that we've done, and this is a Florida bar specific feature that we added to trust books, is this ability to upload a bank statement. We talked about the 6 years and the proper documentation that you need to maintain, bank statements being one of them. So as we were going through the process of being a member benefit with the Florida bar, one of the things that was requested is, can you add the ability to upload bank statements? So we added this. So now you can upload a bank statement. This kind of completes this nice paperless environment so that you've got your reconciliations with your bank statement all in one spot. And you can see I've only got 3 months here, but this is going to save all your prior month-end reconciliations for you. Last thing I'll show you is just on the report side. Build custom reports. This has given our users a ton of flexibility to run basically whatever report, filter down to whatever report they want, hit update, and you can either see it in a PDF or export it to a CSV file. But the other thing we've done is this view month-end reports. So here, I'll just go back to 2019. This is our best practice. Not necessarily rules and requirements, but we wanted a one-stop place that attorneys can go to say, what should I be looking at? And instead of putting the responsibility on the attorney to try and figure out the report to run and how to run the report and how to save it each month, we just built this as a real easy way to go in and say, you know what, at the end of each month, we're going to generate these first 4 reports for you. And then once you complete the reconciliations, we'll add the reconciliation reports in here so that if you're a team member and you want your attorney to go in and say, you know, go look at this. This is what you need to look at each month. This is going to give you that complete, thorough month-end review. Trust ledger, high level, 40,000-foot view, just showing you everything in and out. That's going to be your statement of receipts and disbursements. The payments, everything leaving, deposits, everything coming in. I'll highlight this client activity report. This is one, I haven't seen this really in any other place. And for me, this is kind of my go-to. This is a single report that will list all of your active clients. It starts with the beginning balance for the month, will show any monthly activity for that client, and then end with their ending balance for the month. And so for me, that is a great way to kind of get that gut feel of, all right, does everything look normal? Does it look accurate? Does it look properly recorded for that month? I might have to go and it might raise a red flag and I have to go do some more research on it, but at least I can do a quick scan and kind of at a high level feel like I've got some handle on what's going on in my trust account. That is trust books though. Any questions? Yeah?
Can your software take into account if you have Can your software take into account if you have 2 different banks?
Absolutely, yeah. You can handle multiple trust accounts in trust books. Absolutely. Yep. In this example, I've just got the one. But if you had multiple, you just have a second or a third trust account. We've got a user that's, they handle estates up in New York, and they've got like 60 different trust accounts. I don't know that I recommend that, but yes, it can handle multiple. Yes, sir.
Does it have, we have CLEO.
Okay.
And we're actually in the process of getting rid of it to get case peer.
Okay, yeah.
But does it have a section, because CLEO has trust account, general account. Does it have a section where you can actually have a general account there too?
Great question. So we don't have the general account today.
Okay.
It's one of those things that we're actively building.
You know when,
We're planning on summer. So we're about 70% of the way there on having it built. And by this summer, our goal is to have it live to where we'll be able to handle the trust account, obviously, but also the firm operating account too.
That's what I meant, the operating.
And it's gonna look just like this, and it's gonna be built 100% for legal. That's our world is legal. Yep.
Thank you.
Mm-hmm. Perfect. Yes, ma'am.
What is the maximum number of clients you can have in there?
So the question is, what's the maximum number of clients? I don't know. I know that we've got clients with thousands, or we've got users with thousands of clients. So I don't know that we've had that max where it just shut the software down. I'm sure there is a number, but we've got users with thousands today. So
Where's your support if something goes wrong with the software?
yeah. So support. So we kind of have everything go through a support@trustbooks.com. We've got a knowledge base, so a lot of times it's just a quick, easy. But if it's something we need to jump on a phone call, we're more than happy to jump on a phone call. We find that we spend a little bit extra time on the front end of just kind of getting people updated, getting people situated. Once they are in the product, it's just not complicated. So typically, it's very easy and you're just able to use it. Kind of like the iPhone, just open it up, you're going. Perfect, thank you.
Thank you, everyone. All right, so I am going to give you guys the course number just in case you want to get credit for this. I hope you do. The course number is 3757. That number again is 3757. And if you forget to write it down, you can call us or email us at legalfuel@floridabar.org. All right. Thank you, everyone, for coming.